All right, guys, what's going on? Today, I'm going to talk about one of my favorite concepts that I use when it comes to my trading strategy, and that is going to be the Asian range. Now, the Asian range is from 8 p.m. Eastern to midnight. Okay, so this is the range that I'm typically looking at. I know some people out there might use 7 p.m. to midnight or 6 p.m. to midnight, but I've always used 8 p.m. to midnight. Now, this 4-hour window, basically what it tells us is that trading is typically held in a consolidation, and above the Asian range, right, we have stops, buy stops, and then below the Asian range, we have sell stops. So it's creating a range for us in a consolidation, typically, where liquidity is being built up on both sides of that range. Now, I like using this concept because it doesn't change. The time element doesn't change, and the fact that we have lows and highs printed during this specific window does not change. So every single day, we have levels of liquidity that are very straightforward and easy to understand, because we know during that Asian range, we are going to have a specific high or a specific low that's printed that creates liquidity. And then at midnight Eastern, during London session or New York session, we might take out one side of the range, trade higher, or we might take out the high and trade lower. And when it comes to understanding this specific Asian range, if you guys aren't, you're not brushed up on statistics and probabilities, I'm going to bring up one image that maybe you guys all remember, maybe you don't, but this is extremely important when it comes to trying to visualize the Asian range. Now, what is this? This is called the normal distribution bell curve. So typically on a normal day, price stays within 2 standard deviations. Okay, so that makes up 95, as you guys can see, that makes up almost 95% of a normal distribution on a specific day. Okay, when we have a consolidated day, it's almost making up 70% of that. And when we get past 2 or 3 standard deviations, now we're in outlier territory. And why this is so important to my trading is because each asset that you're trading, right, has a specific daily range limit that they will typically trade before there's some type of mean reversion. Okay, so a lot of my trading is mean reversion. And what I'm looking at as far as markets go is I'm looking for those markets to hit intraday extremes. And if it lines up with my bias, I'm typically trying to go the other direction. Okay, so let's just say, for example, that this normal distribution bell curve is bearish to the left, right? So we have negative standard deviations to the left, and then we have positive standard deviations to the right. Well, actually, this is going to be flipped like this. So bullish is going to be here, and bearish is going to be on the right. And I want you guys to be able to visualize this, because this aspect probably has changed my trading the most when it comes to understanding when these intraday highs and lows are being printed, because it's starting from a range. So the range is starting during Asian session, okay, and that's the normal distribution cycle. But if we trade lower, let's say we trade 1 or 2 standard deviations lower, now all of a sudden, if that aligns with my bullish thesis, we are starting to approach the extremes of how far the market can trade lower before it expands higher. Okay, so I'm gonna take this image, and I'm just gonna help you guys visualize what I look for as far as the Asian range. So let's just say, for example, this here is our Asian range, and we can plot this out. All right, so you have the low down here, and I always mark it out as AR low. Okay, and then we have our AR high up here. So once we trade above or below the Asian range high or the Asian range low, this is what I'm going to look for. So I'm just going to rotate this so you guys have an understanding of what I'm talking about. Now, if the market trades lower to -2 or -3 standard deviations, okay, we're taking out liquidity, and we're also trading to a point where intraday, it might hit an extreme point. And this is on a classic buy day or on a classic sell day. This is exactly what I'm looking for. So on a classic buy day, I want to be able to see this market trade lower and hit one of these standard deviations as an extreme, because that's typically where I'm going to see, a market structure shift or a fair value gap. Maybe we're going to get a displacement. Maybe we're getting turtle soup, right? Taking out a previous day's low. All of those different concepts, when they align with this standard deviation, that's when we're going to see powerful moves where we're going to be able to position ourselves below, right, the midnight open. So maybe our midnight open is here. We can position ourselves below the opening price, and that daily candle will expand higher and it will close higher on the day. Okay, so I want you guys to, kind of pause this video, really study this in depth. This is going to be a very quick video, but it's a very powerful concept. This is one of the concepts that I rely on almost every single day. And what I'm going to show you guys is oftentimes is that you don't necessarily need to spot trading setups. So you don't necessarily need to have a fair value gap. You don't necessarily need to wait for a market structure shift. When you have a very strong opinion of where the market is going to go, oftentimes I use these standard deviation levels as my entry prices, but I also use them as my stop losses and my take profits. So maybe I'm going to position myself at standard deviation 1, and I'll just put a 1 here so you guys can visually see it. And maybe my stop loss is going to be at 2. Okay, and maybe I'm going to target 1, or I'm going to target 2. Okay, so again, pause the video, take some time to really understand this, because, when I was going through statistics in high school and in college, I really didn't pay attention to this. I understood it. It made sense to me, but in the markets, it makes a lot of sense. Because when I was in class, I was like, when am I ever going to use this? But it's very basic. All right, we have the mode or median, and then we have the outliers. So when things get too far out of reach, like intraday, typically markets will snap back, because from an intraday basis, there's only so far the markets will go. Now, let's get into some of the examples, and I'll show you guys on a couple different asset classes. So here we have all of our Asian range deviations plotted out. Now, if we're bearish, typically all I'm looking for from a liquidity rate standpoint is I want to just see the Asian range high be taken out. It doesn't matter what time it is. That I don't really care about that, okay? What I care about is, do I have a bearish bias coming into the day, and do we take out the Asian range high? Because typically when we don't take out the Asian range high, I typically don't do anything. So here, you guys can see that we didn't take out the Asian range high, but we still got a massive run lower. Now, that doesn't necessarily mean that you're not going to take a trade. Maybe there's other reasons for you to take a trade, but oftentimes, if we're not trading below the Asian range, to me, it very much reduces the probabilities that my trades are going to pan out. Because usually what I like to see is, when I'm bearish, I like to see the market not take out the Asian range low, trade higher, and then I can position myself above the open and then target the Asian range low. And there's a couple of examples that I can kind of walk you guys through. But just as, a quick example here, let's say you were just to sell, put a sell limit at the Asian range high, and then you used one standard deviation as your stop loss. Well, maybe you want to target, one of the standard deviations down here. So you can use that same intraday level to set your targets. It's not going to get hit until the following day, but that's pretty much what I'm looking for. So I'm looking from an intraday basis. I'm using these outer boundaries, right? Just kind of take that distribution bell curve and just plot it or visualize it as if it's on the chart. So when it gets to those extreme levels, I'm looking to go the opposite direction. The following day, what do we get again? We get a run on the Asian range high. You could have just shorted the Asian range high, put your stop loss again at 1 or 2 standard deviations, okay? And maybe you're going to target 3 or 4. Very, very simple. And oftentimes these standard deviations do hold up as far as stop loss placements. So let's say, we're approaching a high time frame PDRA, and we have the previous day's low here, right? We've taken out the Asian range low, and we get a nice closure here. Well, you can still use the Asian range deviation as a level where you can possibly place your stop loss. Because let's say if it traded down to this level and it bounced, right? You got a nice closure here, and you're not expecting it to go back down below and retest the one standard deviation. And then maybe you want to target like 2 standard deviations. you guys can see here that it panned out very nicely. Even if you targeted 3 standard deviations and left the trade alone, it would do the same thing. And let's say the next day, we are looking for more longs, right? We're waiting for a sweep on the Asian range lows. Maybe you want to enter on a limit right at the Asian range lows, put your stop loss at 1 standard deviation, maybe give yourself a little bit more room, and target 2 standard deviations, right? You guys can see here that these deviation levels work very nicely. Now here was an outlier. This is the day that Trump spoke. But you guys can see, I believe this is the day that Trump spoke during tariffs. Right? You guys can see here that we had a massively outsized move. So early in the morning, there was an opportunity to go long at 2 standard deviations, but then in the afternoon, it traded up to almost 4 standard deviations, right? And you guys can see how they are limiting price on how far this market is actually going to move. All right, and this is pretty much how I anticipate where I can possibly, expect reversals. I can use them as stop loss placement. So here we have previous day's high, and there was actually SMT at the high. So NQ did not take out its previous day's high, but if you guys want to check Tuesday, the April 8th, feel free to go study those markets. YM, so Dow, and ES, which is the S&P, they both took out the previous day's high. So when I saw this trading at 2 standard deviations, you could pretty much blindly short this level and put your stop loss at 3 standard deviations, right? And maybe you're going to target the Asian range lows. Okay, that's a 2.76 to 1 reward to risk. All right, just using deviation levels, just based on price, because when a lot of times when I'm trading, I don't really care what the candle looks like. I care what the price is on the right-hand side of my screen. That's all I care about. Am I getting a good fill that makes sense, based on an intraday time frame? Okay? So intraday, there's a lot to study here. Sometimes, and this is another nuance that maybe you guys will also pick up, and I'm just going to note it. When we have a trending Asian range, those are days where I typically don't expect highs and lows to be ran out. And in fact, I look at 50% of the Asian range to be respected. So when we have a trending Asian range like this, typically I'm expecting 50% of that Asian range to be respected. Same thing here. We have pretty much a trending Asian range here, right? And 50% of that range is being respected. Okay. When we have very tight consolidated Asian ranges, that's when I'm looking to see if these deviation levels are being respected. Here, there's a nice tight Asian range. We ran out the previous day's high, right? I could short it here. Let's say I just short it as it's trading up into 1 standard deviation. Let's say I just want to short it at 1 standard deviation, put my stop loss at 2 standard deviations, and maybe put my take profit at 1 or 2 standard deviations, right? It takes some time to get there, but it does eventually get there. Maybe if you're just trading intraday, you're just aiming for 1 standard deviation, or you're going to exit based on time. This is still a 2.5 to 1 if you're just blindly shorting the Asian range deviation. Now, the bias needs to line up, okay? But it's very, very important that you guys pay attention to these levels because they do respect them on an intraday basis. I basically use them like pivot points. So if you're wondering how to add these deviation levels to your chart, there's a really great indicator. It's called ICT Everything by Cold Brew Rush. And if you just go into the settings here, all right, make sure that you have time zone selection matching up so your midnight Eastern is actually lined up properly. I have midnight historical lines on, vertical lines on. So I have my midnight opening prices turned on, my weekly opening prices turned on, and then I just use the Asian range. I don't look at CBDR or flout anymore. I just find that the ranges are so close. There's in similarity that it doesn't make that much of a difference. And then I also have SD count to 4. Because sometimes we get really outsized moves where it's trading at 3 standard deviations and you want to be able to see those levels. So I know it was a quick video. It's a lot to unpack. Watch this video multiple times, go in and back test a lot of these concepts, forward test them as well. And if you guys are looking for all the entry models that I use in conjunction with these Asian range deviations, make sure you check out my ultimate guide to trading executions. I'll leave a link in the description. So as always, thanks for watching, and I'll see you guys in the next video.